Hello, I'm Cliff Walsh, Vice President of Asset Management at American Portfolios and Portfolio Manager of the 9 Points Investment Strategies. In this video, I'll discuss the first quarter market action and give you a quick overview of what we expect to see as we look further out to the rest of 2019. Let's take a quick look back at the first quarter since our last market update. Stock markets around the globe rallied significantly after one of the worst fourth quarters on record. The S&P 500 index was up 13.5%, while international developed and emerging market indices were both up about 10%. Bonds were solid as well, with the U.S. Barclays Aggregate Bond Index up about 2.9% in the first quarter. We think that the Fed's dovish pivot has been the main driver behind the recent rally. We also believe that lower bond yields signal weaker growth potential, both cyclically and structurally, perhaps a non-issue in the short term, but certainly concerning as we look out to 2020 and beyond. Some have been surprised by the strength in both equity and fixed income markets. However, increasing correlations between stock and bond returns are not uncommon when the Fed changes course on interest rates. In fact, both stocks and bonds performed well following pauses in the past 5 Fed hike cycles. We think one of the most interesting things to note is that despite the strong risk-on rally in the first quarter, fund flows into the equity markets have been quite weak, which could provide some fuel for the rally to continue if investors look to chase performance. We hope that the strong start in the first quarter, which mirrors the strength we witnessed to start 2018, doesn't fizzle in the back half of the year as it did last year. There have been some big Fed interest rate happenings since our last update, which we wanted to discuss. The 10-year, 3-month U.S. Treasury yield curve inverted fractionally for the first time since the beginning of the Great Financial Crisis in August of 2007. There's been plenty of debate about the inverted yield curve and what it all means to the future of the economy and financial markets, with opinions on the implications ranging from inconsequential to dire. While not a perfect indicator of a recession, an inverted yield curve has preceded recessions 85% of the time. It's a historically reliable but early recession indicator, and it's certainly not foolproof. And of course, there are plenty of nuances to complicate the current situation compared to previous periods. In previous instances, the range in lead times between the inversion and the recession is significant, ranging from a few months to nearly 2 years, which means that the probability of a recession is high, not necessarily near, but could be. There's no doubt in our minds that the markets and economy are in an interesting position. Both stocks and bonds have rallied recently because Fed interest rate hikes have seemingly subsided, but also come with heightened odds of a recession, which will ultimately weigh heavily on stocks and riskier bonds. Outside of interest rates, one of the biggest drivers of volatility in the markets has been tied to U.S. trade policy. With the uncertainty around U.S.-China relations, the ongoing Brexit saga, and negativity surfacing with Mexico as of late related to concerns around border security, there are a lot of geopolitical questions out there. As such, the Global Economic Policy Uncertainty Index sits at near historic highs, but lower than the levels seen around the 2016 and 2018 elections. These are notable levels. The most important issue, in our view, is trade negotiations with China. The recent relationship between the U.S. and China can be best described as a roller coaster ride. The off-again, on-again trade deal appears to be on again and should be a net positive for the global equity markets. While the terms are certainly not finalized on a U.S.-China deal, we expect China to increase its purchases of U.S. exports over the next few years while making changes to its intellectual property regulations and enforcement, albeit probably not as much as U.S. corporations desire. Should a deal be agreed upon in the second quarter, we would expect to see a solid boost in investor sentiment both here and abroad, with the international markets outperforming. We continue to think the Fed's course of action will be a major driver of market activity in 2019. This should not be a surprise. A pause in or completion of the Fed rate hike cycle could help postpone the end of the economic cycle. But regardless of how many rate hikes the Fed gives us this year, the Fed will likely continue to reduce the size of its balance sheet. In our fourth quarter update, we discussed the likelihood that equity market performance would be strong in the first half of the year and most of the gains would be front-end loaded. We still believe that to be the case. Given current strong investor sentiment and a slowing economy, we think that global growth needs to accelerate in the back half of the year if the equity markets are to maintain and build on the early gains had so far this year. A trade deal with China could be the catalyst for that to occur. As we look out to the rest of this year, our focus remains on the global growth outlook, monetary policy and how it relates to the inverted yield curve, and geopolitical risk. The markets have been recently fueled by the Fed's pause in the interest rate hike cycle due to growing concerns about slowing growth rates. While this bad news is good news scenario could drive the markets higher, at some point we expect the market sentiment to turn negative unless growth accelerates from here and provides some positive surprises to macro and company-specific data. We continue to be more likely to fade rallies than buy dips in the year ahead. I hope that you found this market commentary helpful. As always, please feel free to reach out to me or Manager of Due Diligence Sam Rossi if you have any questions or would like to discuss the 9 Points investment management strategies. Thanks for watching.